Hey, welcome back. My name is James Johnson, and my expertise lies in retirement and estate planning. And what I want to talk to you about today is what's going on out there in the market. And so, what's going out there in the market, June of 2022, right now, is we've been on this long ride down. We're at least 22% down on the S&P today, and it looks like there's no end to it. But see, the thing is that the real reason I've come to teach you this video today is it's to talk to those of you that have actually managed to build yourself a maximum funded life insurance policy. See, because now is probably the time to start doing some leveraging. So there are three ways we can get money out of a life insurance policy. There's the sad way, the dumb way, and the smart way. And the sad way is pretty simple. You die, your death benefit goes on to your heirs tax free, and so be it. The dumb way is a word. It's called withdrawal. So when we withdraw money, we're going to withdraw what's called FIFO, first in, first out. So we're going to take out our basis first, and then any money we withdraw above our basis would be subject to ordinary income taxes. But if we use the policy loan provision inside of our policy, we're going to actually be able to borrow money against our policy from the insurance company. So we leave our money in place and we use the insurance company's money to do that. And this is where we have this tremendous opportunity to be doing what's called leveraging. Now, there's a couple reasons why we might borrow money from a life insurance policy. The first one would be major capital purchases. So anything that we can't pay for in full with monthly cash flow, such as a car, something along those lines that we're going to finance a boat, a house, a motor home, whatever the case may be. But there's a second potential investment opportunity here where we could use our money and do what I was calling leverage it up. So let's talk a little bit about major capital purchases. So when it comes to major capital purchases, the first thing we do is we build our policy. And as you know, it takes us a minimum of 3 to 5 years to build that policy. And we're going to build up a cash value inside of there that's growing tax-free, accessible tax-free. We can access it anytime we want, put it back if we want. And when we die, it passes on to 2 to 3 times that amount tax-free. So our cash values increase, and over time, our death benefits increase as well. Now, in addition to that, we can borrow the money out of the policy. So when we borrow the money out of the policy, we're actually not going to remove the money from the policy. We're going to use our cash value inside of our policy as the collateral capacity to borrow from the insurance company. So we're going to go to the general fund of the insurance company. We're going to borrow it out. Let's say we're going to go buy a car. Now, when we go out, we use that money to buy a car. We can pay it back. But while we're paying it back, our policy's still growing, and we pay it back through the insurance company, which is increasing our collateral capacity. Now, the good news about that is we can either make the payment or not make the payment, whereas if we had gone out and we actually financed our car through a bank, let's say, and we don't make that payment, they take the car. Here, if we don't make a payment, there's no harm, no foul. We simply accrue interest as we go, while simultaneously growing interest. So the internal growth as an additional contributions increase the collateral capacity inside of our policy. Well, there's another opportunity out here, and that opportunity is going on right now. As the stock market starts going down here, and as we're seeing the market go down farther and farther and farther, at some point in time, you got to believe there's a bottom. And so the question is, when is a good time to reinvest in the market? And the answer might be right now. So if you've gone out here and you've built yourself a policy and you've got this cash value in the policy, there's no restrictions on the purpose for taking that money out. The insurance company's not going to ask you why you took it, what you're using it for. They're simply going to loan you the money. So we take it out. Once again, we use our collateral capacity to borrow it. We're going to be able to take up to about 85% of what our cash value is. We can pay it back or not pay it back. But now we have the ability to take that out. And let's just say, for example, that, I don't know, maybe our favorite stock has gone down in value by 50%, and we know it's highly undervalued, and it's going to come back. It's going to make a huge jump back. Now may be the time to buy it. So we could go dollar cost average in by taking some money out of our life insurance policy and repositioning that over inside of that investment, whatever it might be. Now, here's the interesting part. As you can see here, is that it really didn't come out of the policy. It came out of the insurance company. We merely have a loan against the policy. So as we pay it back, or as we choose to pay it back, our collateral capacity will grow, and we'll have the ability to go get more money farther down the road. Once again, our internal growth and our additional contributions will increase that collateral capacity. And this is why we built the maximum funded life insurance policy in the first place. Remember, there's 3 ways we can grow our money: tax as you go, tax deferred, and tax free. Under tax free, we have a few choices. We could use a Roth IRA, a maximum funded life insurance policy, or possibly some muni bonds. A maximum funded life insurance policy has about 300% more benefits than a Roth IRA does. But one of the biggest benefits that we have is we can leverage our money by pulling our money out of our policy or using the money that's in our policy and leveraging against it to invest it in other investments down the road. Now, hopefully, this has helped you to understand why you might want to be using a maximum funded life insurance policy in your plan going forward. Remember to subscribe to the YouTube channel below. Follow us on LinkedIn. Remember to live like you're going to die tomorrow. Plan like you're going to live forever, because you just might. Keep smiling, and we'll see you on the next one.